Hello, and thank you for your interest in the Waterfront Balanced and Waterfront Equity separately managed account strategies here at Waterfront. My name is Matt Hekman. I'm the portfolio manager of each of these strategies and wanted to take the opportunity today to talk you through each of the strategies, the unique philosophy, process, the positioning, the performance of each of them, and then give a brief teaser of the outlook for 2023, which we'll spend more time next month giving a lot more detail to. So with that, if you look at each of the two strategies that I manage, you can see some of the unique characteristics of each on this slide. I would point you to a couple of highlights. The first is these are relatively concentrated portfolios with high active share relative to their benchmark. And you can see that in the number of holdings. Each of the strategies ranges from 45 to 75 names. They're a unique, proven cohort of companies that have characteristics that we find attractive. The second thing I'd point you to is that I'm an investor, and I tend to make investments with 1 to 3 year holding time periods. That results in a relatively low turnover ratio, which reduces trading costs. You can see, depending on the strategy, that the turnover ratio of these strategies ranges from 15 to 50%. And I would tell you, on average, over time, they'll average somewhere around 30% per year. The track record of the Waterfront Balanced Fund extends just over 8.5 years. While the Waterfront Equity strategy is one we started relatively recently. It was its inception date was November 16th of 2021. So with that, I'll start by talking a little bit more about the Waterfront Balanced philosophy and process. As you'd expect, it's a balanced strategy. Its benchmark is a 60-40 blend, 60% equity, 40% fixed income. The equity benchmark is the S&P 500, and the fixed income benchmark is the Bloomberg U.S. Government Credit Index. The allocation philosophy and process is one that is predicated or built on a quantitative model that I've developed over years. It's proprietary to Waterfront Asset Management, and it utilizes econometric statistics that we have found tend to lead economic growth and earnings growth, and hence help us to position portfolios to take advantage of the risk reward offered by different asset classes across and through economic cycles. Today, that econometric model suggests, as you probably are well aware, that there are a lot of uncertainties in the future, a lot of reasons to be concerned. There are a number of people calling for a recession in 2023, which may or may not come, but the leading indicators that this model tracks suggest that the outlook at present is relatively uncertain. And as a result, the allocation you'll see on the right-hand side of this chart has equity at 56% of the portfolio. Again, that's relative versus a benchmark, which is 60% equity. And on fixed income, about 42% allocated to bonds with a balance in cash. I would tell you that the quantitative model that we use to set allocation is purposefully slow moving. And the reason for that is the allocation decision is one we hope to make relatively infrequently, and we want to focus on driving relative outperformance versus the benchmark via security selection. Within the equity sleeve of the portfolio, the unique attribute that we can empirically observe and show you is that profitability is an attribute that's obviously quantifiable and observable, and it's one that history shows tends to be durable. The most profitable companies today are more likely than not to be the most profitable companies next year. That breeds confidence or instills confidence in investing in companies that fit that characteristic today. However, markets find a variety of reasons to doubt that profitability and to doubt the durability of it. We're living through an environment where that's happening right now. People are concerned about economic growth, concerned about earnings growth. And as a result, these companies will pull back. Their share prices will become more attractive. And we look to take advantage of that and create alpha by investing in these highly profitable companies when, for one reason or another, whether it's economic concerns or competitive concerns, when they're attractively priced. The fixed income sleeve or strategy is focused on capital preservation as opposed to capital appreciation. And it's focused on generating current income in the form of interest payments. Fixed income investing is inherently asymmetric. And by that, I mean, when you invest in a bond, you anticipate getting that relatively modest coupon, annual rate of return, with your principal returned at maturity. That's the best case. The risk is, for one reason or another, that coupon isn't able to be paid, and you get much less than your principal back at maturity because of a credit event. In that way, fixed income investing, if you're right in your security selection, generates a modest return, but if you're wrong, could produce a meaningfully negative return. That risk reward is asymmetric. And so I'm very focused on preserving capital by avoiding credit mistakes while generating some current income for the strategy as a whole. As you look at the allocation, as I previously mentioned, at a high level, the balanced strategy is conservatively positioned, just acknowledging the risks to the outlook that are in the news on a regular basis. And so I'm underweight equities, and within the fixed income portfolio, you can see I'm underweight credit. Over 2/3 of the portfolio is invested in treasuries. The weighted average duration is 4.8 years, which is shorter than the benchmark. And the yield to maturity is relatively attractive, but much more conservative than what you could get as an example with higher yielding instruments. The current weighted average yield to maturity for the fixed income sleeve is 4.4%. The next slide is a brief overview of the performance. As you can see, the Waterfront Balance strategy relative to peers had a strong 2022. As you're unfortunately probably very well aware, it was a difficult year for risk assets, but the balance strategy declined 11% over 22. That's versus peers that declined almost 14% over that time period. And the S&P 500, which fell 18, and the Bloomberg U.S. Government Credit Index, the strategy's fixed income index or benchmark, which declined a little over 13.5%. You can see that this strategy has produced relatively attractive returns over longer time horizons. The 3-year and 5-year annualized returns relative to benchmarks are relatively strong. And we hope, obviously, that continues into the future. With that, I'll transition to the Waterfront Equity strategy. The Waterfront Equity strategy is a very focused equity-only strategy focused on finding highly profitable companies that are trading at reasonable valuations with catalysts that we think will unlock upside over a 12 to 36-month time period. As I mentioned earlier, profitability is a characteristic that tends to have durability. Well over half, just over half of the most profitable companies today, based on history, are more likely than not to continue to be the most profitable companies a year from today. However, for a variety of reasons, investors become concerned and begin to doubt that profitability characteristic, and will discount the stock prices of these companies in anticipation of a decline in that profitability. What's been proven over time, though, or what we see happen over time, is that for companies that have unique characteristics, competitive advantages that are varied depending on the sector or industry group, or sometimes even the company, those competitive advantages tend to be durable. And in the midst of an environment like we find ourselves in today, tend to create even stronger competitive advantages into the future. These companies are able to, as an example, continue to invest in research and development, even as markets decline and revenues pull back, as consumers retrench and businesses pull back on their investment spend. These companies, while they feel the impact, have the wherewithal to continue to invest in R&D when peers can't, which means on the other side, when the recovery eventually happens, and the recovery will happen, that competitive advantage that they have today not only is durable, but actually expands. In a similar manner, these companies are able to retain key talent. Their best employees, they're able to continue to compensate and pay even through difficult times, which drives innovation and relative advantage in future time periods. And so I'm very focused on finding a small number of companies that have those kind of unique competitive advantages that will prove durable and will produce excess return over a longer holding period. As I mentioned earlier, the outlook today is relatively uncertain, and you'll see on the characteristics right-hand side of the chart that the allocation to equity today is about 94%. Cash is 6%. On average, over time, I generally expect cash to be very low in this strategy. 0 to 3% is my target. The reason for the elevated level today is twofold. First, these companies in the difficult environment we've been through in 2022, many of them produced relatively strong returns, some of them positive returns in a difficult backdrop. And as a result, those stocks attracted a lot of interest from investors, and their valuation multiples expanded to levels that I find at least adequately represent or acknowledge the attractiveness of their businesses. In some cases, overvalue what I think those businesses are actually worth. And so I took the opportunity to reduce my exposure to those stocks, and in some cases entirely exit them. And that obviously created cash. On the flip side, I've been slow to redeploy that cash into new opportunities. There are many in the market today, and I anticipate that there will be many in the coming months. And I look forward to putting that cash to work in investments that I hope will produce really attractive returns over the next 3, 4, or 5 years. But I'm trying to do so in a very methodical, measured manner to make sure that my timing on those buys is as advantageous for you and for the strategy as a whole as possible. As you can see on the next slide, the strategy in a difficult year produced relatively attractive returns. Waterfront equity portfolio was down a little over 11% last year, and that compares to its benchmark, the S&P 500, which was down 18%, and the peer group, which is the Morningstar large blend category, which was down almost 17%. It says a limited track record. As I mentioned, we just started this strategy on November 16th of 2021, but we're pleased by the performance so far and hope to continue that into the future. So as promised, I wanted to give you a little bit of a teaser just to highlight our outlook, or my outlook for 2023. As I mentioned, the outlook today is one that is incredibly uncertain. I'm expecting economic growth as measured by GDP to continue to decelerate as it has been through all of 2022. And my best guess on average is that growth decelerates to somewhere around flat to slightly positive. I think earnings growth for the S&P 500 is likely to decline somewhere in low to mid-single digit range. And as a result, I think the S&P 500 index is likely to experience continued declines, though hopefully less than the ones that we all experienced in 2022. I also expect that inflation will continue to decelerate as it has through the back half of 2022. I think that will continue into 2023. But that path toward the Fed's target, which is CPI closer, somewhere around 2%, I think is likely to prove more difficult than currently the consensus expects. I think inflation is going to prove stubbornly elevated. And as a result, I think the Fed's going to have to continue to be more hawkish, and both in terms of their policy as well as their commentary. And so my best guess is that the 10-year yield on the last day of this new year, December 31st of 2023, will be approximately 4.5%. Now, there will be a lot more detail. I look forward to giving that later in next month. And I would encourage you to put that on your calendar and stay tuned for more details as that comes out over the ensuing weeks. But I want to point you to my true north. Macroeconomic forces and trends change. Competitive environments change over time. I spend my time focusing on finding profitable, growing companies whose securities are trading at reasonable valuations. And I look for catalysts that will drive relative outperformance in those securities over an investable time horizon. And in the midst of uncertainty, in the midst of talk of recession, this philosophy and process, I'm convinced, has been one that has produced excess returns in the past, and I have confidence that it will continue to do so in the future. So again, thank you for your interest in the Waterfront Balanced and Waterfront Equity separately managed account strategies, and I wish you the best in the rest of your day.